When it comes to building true generational wealth, the difference between winners and losers in the stock market boils down to one thing: patience. Warren Buffett said it best: "The stock market is a device for transferring money from the impatient to the patient." And right now we're witnessing a historic moment of impatience. The headlines are screaming panic. The S&P 500 has plunged 10%. The Nasdaq 100 is down 15%. Small caps in the Russell 2000 have crashed over 20%. Volatility is surging, the VIX just spiked to 30, and the Fear and Greed Index has cratered into extreme fear territory at 14. Everywhere you look, investors are scrambling to sell, desperate to cut losses, convinced the sky is falling. But here's the truth they don't want you to see. This isn't the end. It's the beginning. Corrections like this are not signs of collapse. They're invitations. They're the market's way of shaking out weak hands, clearing the path for those with the vision and discipline to buy when others are paralyzed by fear. This is how Buffett and every legendary investor before them built their fortunes, not by following the herd, but by stepping in when everyone else ran for the exits. In this analysis, we're going to break down 3 world-class companies that have been unfairly crushed in this correction. Stocks with the potential to deliver life-changing returns for those bold enough to act now. The question is not whether the market will recover. It always does. The question is, will you be positioned when it does? Let's begin with Alphabet Inc. Goog, a stock now trading 21% below its peak, unfairly punished by the current market chaos. What most investors are missing is the bigger picture. Alphabet is no longer just the world's dominant search engine. It is evolving into an artificial intelligence powerhouse and a cloud computing titan. Its Google Cloud platform recently posted an impressive 30% year-over-year growth, outpacing rivals thanks to surging demand for AI infrastructure. Meanwhile, Alphabet's Gemini AI models are setting new industry standards, offering cost advantages that could shake up the entire AI space. And despite concerns about AI-driven competition, Google's core business remains strong. Search ad revenue climbed 13% year-over-year, while YouTube ad revenue jumped 14%, partly boosted by political ad spending. In its most recent quarter, Alphabet generated $96.5 billion in revenue, up 12% year-over-year, a staggering number for a company of its size. More importantly, profitability is soaring, with operating margins expanding to 32% and Google Cloud's margins nearly doubling in a single year. Alphabet is proving it can scale both AI and cloud while driving higher profits. Yet, the stock is trading at one of its cheapest valuations in over a decade. Historically, Alphabet's price-to-earnings ratio has hovered between 23x and 25x. Today, it's significantly lower. A simple return to its historical average would imply upside of over 28%, before even factoring in future AI-driven growth. This is precisely the type of value Warren Buffett capitalized on. When fear overshadows fundamentals, patient investors win. Next up is Amazon.com Inc. AMZN, another titan unfairly caught in the correction. Amazon's stock is down 20% from its recent peak, but the market is missing the long-term story. For over a decade, Amazon has quietly built one of the most advanced robotics ecosystems in the world. What began in 2012 with the acquisition of Kiva Systems has evolved into a deployment of over 750,000 robots across its fulfillment network. But this is far more than a cost-cutting exercise. It's the foundation of an entirely new business model. Just as Amazon turned its internal cloud platform into the $90 billion a year AWS juggernaut, it is now applying the same strategy to robotics. The company is integrating AI-powered robots into its warehouses, gaining an unmatched edge in automation. More importantly, it's preparing to roll out robotics as a service solutions through AWS. The global industrial robotics market is projected to reach $60.5 billion by 2032, and AWS's RoboMaker platform is positioning Amazon to dominate this emerging industry. Finally, we turn to the undisputed king of the AI revolution, Nvidia Corporation, NVDA. Despite its dominance, Nvidia's stock is down 23% from its highs, creating what could be a once-in-a-decade opportunity. The company's latest earnings report was nothing short of historic: $17.2 billion in year-over-year revenue growth, a staggering 78% increase. Nvidia has guided for an eye-popping $43 billion in revenue for Q1 2026, yet the market continues to underestimate the scale of Nvidia's runway. The market is handing patient, disciplined investors some of the best setups we've seen in years. The question is, will you seize the opportunity or will fear hold you back?